Welcome back. Today, we're diving into a topic that challenges everything you've heard about building wealth: why compound interest isn't the magic solution, unless you're already rich. You've heard the hype: just invest a little each month and let compounding do the rest. But the truth? Compounding doesn't actually work the way you think, not unless you've got a serious amount of money to start with. Let's break it down and show you how the wealthy really use compounding, and how you can shift your strategy today. Compounding is often called the eighth wonder of the world, a financial force so powerful that it can turn modest investments into millions over time. You've probably heard advice like, just invest $100 a month, and one day you'll be rich. But there's a hard truth that's rarely talked about: compounding doesn't work the way most people think, unless you already have a large sum of money. That might sound discouraging, but understanding this truth can empower you to approach wealth building with a smarter mindset. In this breakdown, we'll uncover why compounding seems like a magic trick only for the rich, why small contributions don't generate life-changing returns for decades, and what you can do instead to make your money grow. The illusion of early compounding: financial gurus love to show examples like this. If you invest $5 a day starting at age 20, you'll have over $1 million by retirement. Sounds amazing, right? The math works, but there's a catch: that $1 million doesn't appear until 40 to 50 years later. And in the early years, the growth is barely noticeable. Let's say you invest $1,000 at a 10% annual return. After 1 year, you'll have $1,100. Not bad, but hardly impressive. In year 2, it becomes $1,210. After 10 years, you've got about $2,593. It takes decades before compounding becomes powerful, unless you start with a massive base. Here's the problem: most people don't have the time, income, or patience to wait 40 years for compounding to kick in. And that's where the myth starts to break. Why the rich get richer and compound faster: wealthy people don't rely on small monthly investments to build wealth. They use large sums, ownership, and cash flow to supercharge their compounding. Let's look at an example. Person A invests $1,000 a year for 20 years. Person B invests $100,000 once and lets it sit. Assuming the same return, 10%, after 20 years, Person A has about $57,000, Person B has over $672,000, same interest rate. Very different results. Why? Because size matters. Compound interest is a percentage return. A 10% gain on $1,000 is just $100. But a 10% gain on $1 million is $100,000. When you already have money, your money works harder and faster. That's why billionaires don't chase small investment returns. They leverage scale. Compounding favors those who already have large capital, not beginners scraping together $50 a month. Time alone is not enough. Most compounding examples assume you'll leave your money untouched for decades. But life isn't that predictable. Emergencies, inflation, job loss, health issues, real life often interrupts the plan. Even if you're a disciplined investor, here's the truth: compounding grows slowly at first. And unless you're contributing large amounts, your portfolio may stay small for years. The financial industry rarely talks about this because it's not exciting to say, compounding works great if you're already rich, or wait 40 years. Yes, time is important, but without meaningful capital, compounding moves at a snail's pace. The math behind compounding: let's break it down with an example. Imagine two people invest at 10% annual returns. Investor A, $10,000 initial investment. Investor B, $500,000 initial investment. After 20 years, Investor A ends up with $67,275. Investor B ends up with $3.36 million. The difference isn't effort or intelligence, it's starting capital. That's why the wealthy appear to get richer automatically. Their compounding engine is already massive. Each year, their money snowballs faster, producing life-changing gains without needing to work for it. This is the brutal truth: compounding interest favors those who already have wealth. Why small investors feel stuck: if you're saving $100 a month, you're doing the right thing, but you may feel frustrated when your investment doesn't take off. Here's what happens to a $100 per month investor earning 10%. After 10 years, tilde $19,000 after 20 years, tilde $68,000 after 30 years, tilde $198,000. It's something, but not enough to change your life in the near term. And remember, inflation reduces the purchasing power of that money by the time you need it. That's why so many people feel like they're doing everything right, but not getting ahead. They're relying on a tool, compounding, that wasn't designed for small amounts in short periods. So what can you do instead? 1. Focus on increasing your income. The more you earn, the more you can invest, and the faster compounding becomes meaningful. Instead of squeezing small returns from tiny amounts, grow your income so you can invest larger chunks. 2. Build and sell assets. Wealthy individuals often create businesses, real estate portfolios, or intellectual property that generate lump sums or passive cash flow. These can be reinvested at scale, making compounding far more powerful. 3. Use leverage wisely. Leverage, like borrowing to invest in real estate, can multiply returns. It's risky, but with education and discipline, it's how many investors grow their capital base large enough to truly benefit from compounding. 4. Compound knowledge and skills. Not all compounding is financial. Skills, experience, and connections compound over time, too. They can lead to better jobs, better deals, and bigger opportunities, allowing you to build wealth faster. The real formula for compounding power. Compounding isn't magic. It's a math formula. Wealth equals capital times 1 plus rate of return, caret time. Most people only focus on time. But without capital and returns, time alone won't make you rich. The real secret is to earn more, invest bigger chunks, reinvest aggressively, avoid setbacks, debt, lifestyle creep, etc. Then, and only then, does compounding truly work. Final thoughts. A tool, not a shortcut. Compound interest is still one of the most powerful financial tools in existence, but it's not a shortcut for the poor to become rich overnight. It's not magic. It's math. If you're starting with small amounts, understand that compounding can help, but it's not enough on its own. Don't rely solely on it. Focus instead on building a large capital base, improving your earning power, and making smarter investment choices. The wealthy use compounding not because they wait 40 years, but because they're starting with millions. That's the real secret behind the results you see. So if compounding feels slow for you, don't be discouraged. Use that frustration as fuel to grow your income, invest more aggressively, and play the long game, but with the right expectations. Because compounding works, but only after you've worked for capital. If compounding has ever felt too slow or overrated, now you know why. It's not about how long you wait, it's about how much you're working with. Thanks for watching. If this gave you a new perspective on money and wealth, don't forget to like, comment, and share your thoughts below. And if you're serious about mastering your finances, stick around, there's a lot more coming your way. See you in the next one. Stay smart, stay focused.